Howdy, everybody. Welcome to Liberty Call. Today is Thursday, May 16th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a beautiful day here in Colorado. Cool breeze, sun's out. It's just magnificent. Been outside with my doggy playing some ball a little while ago. I was killing some time waiting for 2 o'clock. And here we are. So hope you're having a good day. If it is your first time watching Liberty Call, if you could do me a favor, yes, you in the brown shirt, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell, because you don't want to miss anything that I might say that's smart. Probably not today, and it definitely won't be tomorrow. So a broadcast note, there will probably not be a video tomorrow because I'm going to be traveling, and then all next week I'm going to be on a cruise ship. So I will be working, but I will be a little further away from the friendly confines of DSA Financial Group's world headquarters. So anyways, all right, well, let's go ahead and jump into the numbers for today. Markets were in a less good mood. Dow Jones was down 0.1%, 38 points, closed at 39,869. The S&P 500 down 0.2%, closed at 52.97. NASDAQ down 0.26%, closed at 16,698. Let's see, the VIX was up 0.16 today. It's at 1247. Canada up 0.07, Brazil up 0.16, and Mexico up 0.1%. In Europe, Germany was down 0.76%, the UK down 0.08%, France down 0.63%, the Netherlands up 0.02%, Spain down 0.56%, Italy up 0.12%, Switzerland up 0.4%, and Portugal down 0.72%. Russian exchange is both green today. The MOEX up 0.43%, the RTSI up 0.57%. And the Asian markets, what is that? The Nikkei was up 1.41%, Australia up 1.65%, New Zealand up 2.17%. In China, a little more muted. The Shanghai was up 0.08%, Shenzhen Component up 0.22%, China A50 up 0.77%, DJ Shanghai up 0.12%, Hang Seng up 1.59%, and the Taiwan weighted has not been open since the 14th. All righty. So those are today's markets. The Dow briefly got over 40,000 for a brief stretch, but then fell back into the red for the day. So, all righty, let's go ahead and get to our market recap. Dow briefly tops 40,000, first time ever, but Treasury yields cap gains. All right, where's my notes? Here we are. On Thursday, the Dow briefly surpassed the 40,000 point mark for the first time, but relinquished gains after investors evaluated a rebound in Treasury yields alongside Walmart's strong performance. Walmart surged over 7% after exceeding fiscal Q1 expectations and raising its guidance, contributing positively to the Dow. Similarly, Canada Goose Holdings saw a significant increase of over 16% following its better than expected fiscal result or quarterly results and optimistic annual margin forecast. Expectations for a September rate cut bolstered stocks, driven by Wednesday's lower than anticipated consumer price index and indications of a cooling labor market. Initial jobless claims fell back down to 222,000 for the week ending on May 11th, slightly missing economists' projections of 219,000, but showing a decline from the previous week's revised 232,000. And if you look at the charts, there was another article I read on Zero Hedge earlier today that most of the huge gain in job losses and then the huge contraction this week comes from New York. So who knows what's really going on there. However, Treasury yields rebounded from their previous slump as Federal Reserve officials, including Meester, emphasized the needs for ongoing data monitoring to ensure inflation is on a sustainable downward path. Well, we haven't really seen that yet. Meester noted that achieving the 2% inflation goal might take longer than initially anticipated. Yeah, all these Fed officials have been coming out saying, yeah, we're not doing nothing until I mean, I guess these people on Wall Street and these financial journalists just seem to think that, oh, it went down a little bit. Oh, let's just lower rates. No, because that's what created the problem, you idiots. All right, moving on. Chubb reached a record high, rising 4% after Warren Buffett's Berkshire Hathaway disclosed a $6.72 billion stake in the insurer. Conversely, Meta Platforms saw a 1% decline as the European Commission initiated an investigation into potential violations of online content regulations related to child safety. Uh-oh. Overall, the day's market activity reflected a complex interplay of corporate earnings and economic data and monetary policy expectations, with significant individual stock performances influencing the broader indexes. Some were up, some were down, and it's kind of just mixed for today. I guess probably the best way to put it. All right, let's dive a little deeper into the data. Start now with April housing starts. This comes from First Trust, and Nate Guernsey is the author. All right. In April, housing starts experienced a rebound, but remain lower than levels observed in late 2023. The primary factor affecting housing activity is elevated mortgage rates, driven by recent higher inflation reports. Many current homeowners are reluctant to sell their properties and give up their favorable sub 3% fixed mortgage rates. Yeah, I'm kind of one of those people, prompting prospective buyers to turn to new builds, thus supporting demand for developers and maintaining construction activity. The report shows that the increase in April was entirely due to a substantial 30.6% rise in multifamily starts, while single-family starts remained virtually unchanged, decreasing by 0.4% from the previous month. Home builders appeared to prioritize completing existing projects over starting new ones, as evidenced by a 15.4% surge in single-family home completions, marking the second largest monthly gain since 2019. There is a notable divergence between single-family and multifamily development. Over the past year, single-family starts have risen by 17.7%, while multi-unit starts have dropped by 33.1%. Similarly, permits for single-family homes have increased by 11.4%, whereas multi-unit permits have declined by 21.9%. This disparity is attributed to the unique economic conditions of the past 4 years since COVID-19 pandemic began. Although housing is not expected to be a significant driver of economic growth in the near term, a housing bust similar to that of the 2000s is unlikely given previous decades underbuilding, which should help support home prices. In other news, the NAHB Housing Index, reflecting home builder sentiment, fell to 45 in May from 51 in April, indicating more builders view conditions as poor rather than good. Let's see here. On the trade front, import prices rose by 0.9% in April, and export prices increased by 0.5%, while import prices up 1.1% and export prices down 1% over the past year. So, all right. And there was also some details in there about the employment numbers. We already covered that in the last article, so I skipped over that. All right. Next up, also from First Trust, this one, April Industrial Production and Capacity Utilization by Bryce Gill. See what Bryce had to say here. In April, industrial production paused after 2 months of growth, with underlying details weaker than the headline figure. The manufacturing sector significantly contributed to the slowdown, dropping 0.3%. This decline was mainly due to a 1.9% fall in auto production, which likely normalized after earlier production surges aimed at recovering from late 2023's large-scale strikes. Non-auto manufacturing, considered a core segment of industrial production, fell by 0.1% in April and decreased by 0.5% year over year. Despite the overall manufacturing slump, high-tech equipment production increased by 1% and has risen by 9.4% over the past year, marking the strongest growth among major categories. This surge is attributed to investments in AI and the reshoring of semiconductor production. However, the sector's activity has started to decelerate, indicating the initial boost from the CHIPS Act might be waning. The mining sector also weakened with a 0.6% decline in activity. Decreases in new well drilling and extraction of various minerals and metals outweighed gains in oil and gas production. Conversely, the utility sector, known for its volatility and weather dependence, was the strongest performer, increasing by 2.9% in April. Additionally, the Philadelphia Fed Index, a regional factory sentiment measure, dropped to plus 4.5 in May from plus 15.5 in April, indicating a decrease in factory optimism in the area. All right. So good stuff, folks. Good stuff. One last article here comes from our buddies over Zero Hedge. $27,000 gold. Woo! This comes to us via James Rickards of dailyreckoning.com. So let's see what he has to say. Mr. Rickards, writing for Daily Reckoning, updates his forecast for gold prices, suggesting that gold could exceed $27,000 per ounce. Whew, I wish. This projection is based on rigorous analysis rather than speculation. Rickards explains that a potential collapse in confidence in fiat currencies driven by excessive money creation, competition from cryptocurrencies, high levels of dollar debt, or economic crises could force central bankers to reinstate a gold standard to stabilize the global monetary system. Rickards' analysis starts with determining the implied non-deflationary price of gold in such a system. He calculates this by considering the U.S. M1 money supply, which is 17.9 trillion, and assumes a 40% gold backing, historically used by the Federal Reserve. This requires $7.2 trillion worth of gold, translating to $27,533 per ounce when spread across the U.S. Treasury's 261.5 million troy ounces of gold reserves. If it's still there, I doubt it's still sitting in Fort Knox, but it could be. Rickards notes that the supply and demand dynamics also support his forecast. Gold mining output has decreased since 2017, despite rising prices, indicating difficulties in sourcing high-quality ore. On the demand side, the central bank purchases of gold have surged, reaching a record 1,100 metric tons in 2022, with strong demand continuing into last year. He emphasizes that gold prices increase. He emphasizes that as gold prices increase, each subsequent $1,000 gain represents a smaller percentage increase, making higher price levels more attainable. Rickards advises investors to buy gold now to benefit from both early price percentage gains and larger absolute gains as prices climb towards his projected levels. All right. Again, this is his opinion, not mine. I would personally love $27,000 gold. I mean, that would be, my portfolio would very much thank you. But anyways, all right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. Again, remember, program note, probably no show tomorrow, and they may be hit or miss next week, depending upon my internet situation while I'm abroad. So, like I said, anyone needs anything from me, please send an email. I'll get back to you as soon as I can. And other than that, hope everyone has a great day, and I shall talk to you next time I broadcast. Adios.